Well, Truffle Asset Management was founded in 2008 and believes in following a bottom-up approach to investing. Truffle offers long-term equity and hedge fund products, as well as tailor-made structured investment solutions to selective clients. Charles Booth, portfolio manager at Truffle Asset Management, joins us in studio to chat about their flexible fund. Thanks so much for your time.
Pleasure, Bronwyn. Thank you.
Let's go to the start of the flexible fund, the rationale for the fund and how it's doing right now, Charles.
Bronwyn, we've got two funds. We've got an equity fund and a flexible fund. Now, the rationale for the flexible fund is that the investment proposition for our equity fund is that we will stay fully invested at all times. But for those people that want us to take a view on markets and move between equities and cash when we see it appropriate, we do that in the flexible fund. So it is an equity fund, it's not a balanced fund, but where we don't see opportunities in the market, we will hold cash, and where we do see opportunities, we will hold equities. So there is a difference between those two funds.
Sorry, and in terms of that flexible fund, what position are you taking now?
Okay, as we stand at the moment, we are about 16% in cash. Most of that cash is in South Africa, although we do have a small portion of it overseas.
That 16%, is that considered, would you consider that high or low relative to recent history?
Okay, I guess it's probably a bit on the low side, and I would say that we would probably reduce that in future, but it's not that far from our long-term average cash, which has been more or less about 20%.
In equities, let's jump right into that space. Where do you deem the opportunities to lie?
Bronwyn,
perhaps starting from a sectoral approach.
Okay, we are very slowly starting to increase our exposure to resources. Now, it's not an easy thing, because although resource stocks have fallen, so have commodity prices. So we really don't know where the bottom is going to be, and it's quite possible that the bottom could be further down from where we are now. But in our view, they're starting to come into some sort of value range, and it's appropriate in our mind to start slowly increasing exposure. As we stand, we are still underweight resources, but we are less underweight than we were.
And the move into resources is away from which sectors? In other words, in general sectors, what are you selling to go into the resource space?
Okay, the sectors that we think are now currently overvalued are more the consumer sectors, the retailers. And there's no question that they are in a very good space at the moment. So the news flow coming through on the retail side is very good, and we think it's probably going to continue to be good.
Were you able to capitalize on that upswing?
We were, but just as you would expect from value investors, you always get out too soon, and I think we fell into that category as well.
Charles, in terms of your exposure to the resource sectors, which particular resource stocks are you moving into at the moment?
The ones that we've started to increase exposure are Anglos, and also a little bit of Sasol. The thesis is that Anglo's share price has really come off a lot, and we're starting to see a lot of value in the underlying components of Anglo's ex Kumba, because in fact, interestingly, Kumba hasn't come off that much. So that's one that we still think in the sector, although the sector is cheap, Kumba is, in our view, quite expensive.
Can I just ask Charles about a specific aspect to Sasol versus Billiton? A lot of people can look at those as being comparable in some sense, not entirely, but in some sense. Your choice of going into Sasol versus going into Billiton, why Sasol over Billiton?
Well, I guess Sasol's share price has come off with the oil price. It's on, we think, quite an attractive, about a 5% dividend yield. And we think that it is discounting oil prices that are low compared with the recent past. But to be honest, we've also been nibbling a little bit at Billiton as well. So it's not that we think that Billiton is bad value relative to Sasol.
What about Steinhoff, having said that the retailers have run so hard and that you perhaps gave them up a little early as value investors? Steinhoff is still a play for you?
Very much so. Steinhoff has been one of the core holdings that we've had in the fund virtually since inception. And the thesis there is not so much the retail play in Europe, but it's more the ability of the company to rationalize the furniture sector in Europe now that they've taken over Conforama, So we think that that's one of the sort of long-term positives, although one has to say that the cycle currently is working against them. The second investment thesis in Steinhoff is that if they list the international operations separately, we think that the combined group could get a better rating, and that could be a benefit to shareholders. So the play is not just simply one of consumer spending. There's a little bit more to it than that.
And if you guys do have a value bias within your fund. It's not an out-and-out value play, but there is a value bias.
Yes, we
Are
do.
there other sectors that, besides resources, are there other sectors that you think we should be paying attention to from a value perspective?
i.e. construction. Am I finishing your
Yes,
sentence?
yes, I'm
i.e.
getting there,
construction.
getting
That's
there.
where he
Okay.
was going.
That's okay. That's a very good question, and I have to say that in terms of our ranking table valuations, construction stocks are starting to rise up the table, and they're looking quite interesting. We have not yet pulled the trigger on them, and I guess one of the reasons is that the construction cycle tends to be long, and it also tends to be a bit of a lagging indicator. So I think we need to see a little bit more good news on the economy first before we get it. But I take your point that they are starting to look interesting, and it's certainly one that we will be looking at a little bit more closely. But as we speak at the moment, we don't have construction.
Are you fairly encouraged by some of the activity we're starting to see, the Transnet spend? Is that something you'd be looking at? Or is it way too early? In other words, it's looking more encouraging. Is this still way too early? Do we have to wait quite some time before there's actual, not just plans and not just an order book, but a lot more on the ground activity?
That's a difficult question, because what we know from markets is they do tend to anticipate. So one could expect that the shares would start performing before the companies start performing. And that really is just trying to second guess the market. So we wouldn't really have a strong view on that. But having said that, though, we just think it's a bit early.
I'm jumping now to MTN, and I see it's a big holding
Yes,
within your flexible fund.
Yes, it is.
You are not concerned about the potential reputational damage, the potential corruption. You think that perhaps all that news flow is overdone?
Bronwyn, of course, we're concerned about it, and that's one of the negatives in the company, and that's why we think it's trading at the price that it is. But if one looks at the underlying business in MTN, it's relatively strongly capitalized, it's got very strong cash flows, and if you look in the last 5 years or so, you'll see that dividends have increased significantly faster than earnings, and we would expect that to continue. So there's a very real prospect that MTN could be on a 7 or 8% dividend yield, and that in our mind is very attractive. You've got to ask yourself the question, why is it on that yield? And of course it's exactly those issues they're facing in Iran. Now, if it comes to a worst case scenario, I guess maybe it's justified, but you've got a big safety net in that dividend yield.
And something like Telkom, would that come on your radar at all, or is it just not an option?
Wow, that's a tough one. Because Telkom should be performing a lot better than it is, and I think it's almost the sort of the classic value stock. But I guess the risk is that it might be a value trap.
And it has been to this point. It's been a value
Well,
trap.
I think it's worse than that, because, I mean, every single instance, it feels like, where they've come up with a strategy and people have got excited about it and argued for it to be in a value portfolio, it's let itself down in terms of the execution of that strategy.
Yeah.
So you'd have to question, what is the strategy now? And it appears quite vague, whether you start to eventually you just delist it. I guess that's an option in the end.
It is. Telkom has got great assets. I mean, they've got a network in place, and they've just got to make that network work. I guess it's an indictment on management, that management just have not delivered.
We haven't got your view on the financials, and obviously, again, we've had some negative news flow. We had the voluntary profit warning out from ABSA recently, which knocked the share price, and then obviously the parent came under fire for other reasons with Bob Diamond's resignation. In general, do you think that this is a precursor of things to come in the financial sector, or do you think that this is an isolated ABSA Barclays case?
I think that could be a bit of a warning sign, because ultimately the health of the banking sector is dependent on the health of the consumer. And for our understanding, these are bad debt write-offs in ABSA. Now, I would guess that some of them may be specific to ABSA, but I think it could well be a forerunner of maybe the consumer is running out of steam a bit.
Do you think, from your perspective, we could find ourselves where we get the next earnings cycle and we start to get big downward surprises? Is that something that's possible? In other words, if you look forward to South Africa's earnings, take the resource sector out, look at the financials and industrial shares. Is there downside risk to earnings estimates that analysts are currently putting into portfolios?
I think there is, yes. There is.
And do you think that could potentially be a global? We're starting the US earnings season this week, I think. Do you think earnings can hold up, or do you think we're into a phase where earnings generally are coming under pressure?
Kevin, I don't know enough about the US market to really make an informed comment on that. But just if one brings it back to South Africa, I think there are a lot of expectations that have been built up into, and I said earlier, the retailers. Now, there's no question that in the next reporting period, things are great. And there's no question that most companies will show very strong growth. But one's got to question whether that is sustainable in the earnings period after that and thereafter. So, maybe earnings slow down a bit.